yet. And there seems to be a sort of growing consensus, whether it's the markets pricing, analysts, or the Fed themselves, that in general, inflation is no longer a problem. Are you in the same camp or not?
I think I'd say not so fast on that front. And the reason why that is that we have two meaningful tests coming up on whether inflation has durably fallen to 2%. First of all, let's make sure we remind ourselves of the starting point. Inflation is not at 2%. 2% is the Fed's target. PCE is still above 2%. A lot of different ways you can slice it, but between 2.5% and 3%. CPI is above that. Core CPI is above that, and so we're not at the Fed's target in terms of inflation. So that's our starting point. Remember that. Just to get to this point, it has taken remarkable goods disinflation over the course of the last 12 to 18 months. Now, part of that has been a resolution of the supply chain issues that caused a big inflation spike. But at this point, when you look at things like core goods prices, they're disinflating or deflating at a level that was equivalent to or even more negative than pre-COVID levels. Now, do we think that we're in a world where you'd expect an extended period of core goods price deflation? I don't think so. And just the movement of that core goods price inflation back to something at pre-COVID levels, or let's say above pre-COVID levels, given, the global deglobalization dynamics and tariff risks and, various shipping issues. There's a lot of reasons why you might think that core goods would end up prices would end up rising faster than they were pre-COVID. Uh, you know, services inflation is still very elevated relative to pre-COVID. So unless you have to have an extended period of very weak core goods prices to offset the elevated services price inflation in order to get to that 2% level. And the real question is that really going to happen? Or have we gone through a period basically where we're at a price spike related to the supply chain issues, a price normalization related to the supply chain resolution issues, and now we're going to go back to inflating in those prices. So we haven't tested that and we haven't resolved it. And if you think like any person who's like, well, inflation's 2%, what they're saying is we will have relatively extreme core goods inflation forever. And I don't think that that's a reasonable expectation. So that's point number one. Point number two is, let's say we actually get these cuts. We're going to get probably some number of cuts. The question is, do we get a reacceleration of the economy as a function of those cuts? We're already starting to see, mortgage applications for refinancing start to accelerate. Do we start to pick up more activity as a function of that easing? That would be a particularly concerning circumstance because we are not at 2%, right? So having a reacceleration of the economy at a time when inflation has not yet reached the Fed's mandate is another test to see whether inflation is durably back down to 2%. Central banks through time have learned that when you start to cut before you get inflation back to your mandate, that often leads to a second rise in inflation, and that's the risk that the Fed has in front of itself if it continues, if it cuts aggressively at this point.